Hi, I'm James Robinson, and this is my stock pick of the week. This is part 2 of my series on NuSkin, symbol NUS. This week we're going to look at the operations of the company. For me, operations means how good a job does the company do in delivering goods and services to the customer. So how efficiently do they do it? How economically do they do it? What are the characteristics of the company's operations? For me, it may sound strange, but I always start all of my analysis of a company by looking at gross margins. I think companies that have very high gross margins have a high propensity to be profitable. And I think that companies with very low gross margins tend to be companies that are commodity driven. And commodity driven businesses are profitable or not so profitable, typically based on issues that are beyond their control. So gross margins, the definition of gross margin is pretty simple. You take all of the money that you make in gross revenue, you subtract out the cost of your goods sold, and what's left are your gross margins. So what we're really saying here is that we're selling a product that doesn't cost very much to make, but that is in very high demand, and that we have some pricing power on. If a company doesn't have pricing power, if it's a commodity and lots of people are selling products that are virtually the same, then what happens over time is that the cost of that product, the price you can charge for that product, tends to revert down to very close to the cost of production. Because there's so many people making it, you're always constantly being undercut. But if you have a monopoly or a consumer monopoly, you're able to sustain prices that are significantly higher than your cost of goods sold. And so as investors, we're looking for companies that have these monopolies. And again, for me, the biggest single determinant of whether or not it does exist a monopoly is gross margins, and that's why I start my search. That's why I start my search there. So you can see here that I've ranked the companies that I've looked at on their gross margins, and the top 10% of companies have gross margins represented by the purple line. And you can see here that, NuSkin's gross margins are significantly above that. So they're clearly in the top 10% of all companies in terms of gross margins. Those gross margins are relatively stable for a very long period of time. They have been gradually declining since 2014, but they're still significantly above the top 10%. So when I see this in a company, I get very interested and I start wondering what else do I need to know about this company. And so that's why we're doing this research on NuSkin. The next thing that I look at with a company are their earnings. Obviously, it doesn't make sense to own a company that doesn't make any money. And you would like to own a company that makes more money over time than it made in the previous years. So when I look at earnings in two capacities. The first thing I look at is earnings, which is just the total amount of profits that we have as a dollar amount. The second thing I look at is earnings per share. Oftentimes, companies will tout earnings per share as a measure of their profitability and a measure of management skill. And it's obviously often misleading. If a company's buying back shares, then it's easy to raise the earnings per share without raising the earnings because there's less shares that the money's being divided through. So I look at both and I try and compare them and get a sense for what's actually happening in the company through both filters. The earnings since 2007 for this company have more than tripled. Obviously, they were crazy in 2013, 14, and 15. It's dropped significantly since then. But it's been stable and gradually rising. I'm comfortable with this company's earnings. It's not a 10 out of 10. If you think of the operations of this company, I didn't even give it a 3.0. So the operations are sort of the weak link for this company, but they're still very solid. And I'm comfortable that this company will gradually over time earn more and more money, and that they'll do a decent job returning up money to us. There's nothing here in the earnings or the earnings per share that causes me concern. We spoke about gross margins and how the gross margins for this company are excellent, right? The gross margins are, above 70%. But the next thing we care about, and then gross margins again is cost of goods sold subtracted from total revenues. The next thing that we're looking at in this slide is net earnings as a percentage of revenue. So how much actual money does the company make relative to the total revenues? And again, that's an indication. If you know the net margins are really, really high, and as the gross margins are really, really high, but yet the net earnings as a percentage of revenue are slim or slimmer, then that tells you there's a lot of operational costs to run the business, which may or may not be indicative of less than perfect management. And that's sort of what's happening here. Again, I'm being hypercritical. We know from my other videos that 90% of the companies I look at, I would never consider buying. And so when I buy a company and then I say it's not great, it just means it's not great relative to the best companies I've looked at. It's very, very solid relative to the average company that I look at. But you see here that the orange line puts a company in the bottom 25%, And the purple line puts a company in the top 25%, and this company is right in the middle. So basically, the amount of net earnings that flows down to revenue for this company is very average, and that's despite having very, very high margins. So that tells me that the management of this company is less than a 10, but the product is so good that the product survives. Hopefully over time, management gets better and better, or gets replaced. But in the meantime, because the company's margins are so high, we're able to overlook the fact that the gross margins percent of revenue is only average. Another thing to look at is that revenues have been basically flat since 2015. So have revenues, or net earnings, I should say. And so this is a very stable company. And all told, again, as I mentioned before, the operations of this company aren't spectacular, but the management's wealth creation is very good, and the finance of the company are very good, and the gross margins are very good. So despite some of these negative things I'm saying in this video, I still think it's a good buy. So here we see this company selling and general administrative. It's in the bottom, or virtually at the bottom 10% of companies. It spends a tremendous amount of money in selling and general administrative. That tells me that this company is probably, in my opinion, overpaying their sales or not getting enough bang for the buck from the sales. And that's one of the things this is one of the real components that's keeping this company's net revenues from being where we'd like to see them. I don't presume that that's likely to change. It's been that way since 2001. It's always been very high. You just hope that over time the company can gradually do better here and squeeze more money out of this very well compensated money for selling and general administrative. Plants and equipment for the company have been going up basically since 2010. It's now in the middle of the pack, slightly below the middle of the pack in plants and equipment. So again, more things that when I first looked at this company, I thought, man, these gross margins are spectacular. And then I almost lost interest as I was going through these slides and decided I wasn't going to buy the stock. But I continued doing my research, and you'll see in the other slides, in the other videos when we talk about the wealth creation and the dividends and the balance sheet, you'll see that this company is actually very solid. It's just operationally, it leaves a little bit to be desired. So that's plants and equipment and selling and general administrative. So R&D for this company is obviously it doesn't appear that they have any. And that's surprising to me because when I was doing my research on the company, they have a couple of labs and they have apparently 75 scientists on staff doing research. And so I'm just curious as to why that isn't qualified as R&D in their income statement. I don't know I'm not an accountant, I'm not a CPA, and there may be some reason why they can't qualify those people R&D, or some definition for R&D that they fall short of. And it might actually be that some of this R&D cost, for example, is being buried in the selling and general administrative fund, which would then make that not quite so egregious. Because like I say, I do know from my research that they have a tremendous number of, or at least they claim to have a tremendous number of scientists on staff trying to figure out better ways to create products for their customers. Inventories are high. I would like to see them lower. I think this is an area that the company should be able to do a better job than they do. But again, we've sort of talked about this operationally. This company doesn't seem to be as proficient as we'd like. So summary of operations for NuSkin's, it's a kind of a mixed bag. And I want to make sure you understand that I think that you should buy NuSkin's in large part because of its wealth creation, its dividends, and its balance sheet, and mostly because of its price. It's very, very cheap. Its operations are above average, which when you watch this video, you sort of think, wow, this company's operations aren't very good. They're actually fine or better than average relative to the normal company. They're just not very good relative to the companies I usually tell you to invest in. So it's sort of the relevant facts are that it's good versus everybody. It's just not good versus the 15 or 20 companies, I guess maybe 30 or 40 companies that I've suggested you should buy. So in summary, I look for companies with growth margins of at least 40%. This company's gross margins are north of 70%, so that's spectacular. Although it's offset because their net earnings as a percentage of revenue aren't as high as I'd like. The last 13 years, the company's earnings have more than doubled, and that's in addition to having paid significant dividends over that time. Net earnings as a percent of revenue have been basically flat for 5 years. The company's selling general administrative costs are extremely high. And the company's plants and equipment as a percentage of assets have been increasing since 2010, but that's as much a function of what's happening with the assets that we're going to talk about the balance sheet as it is with the plant and equipment going up over that period of time. The R&D for the company is zero. And again, so it's a mixed bag. If you just looked at NuSkin for its operations, I don't think you'd buy the stock. You need to look at it in the context of the other three videos that we're going to do, which again is dividends, wealth creation, and the balance sheet. And I think after those, you get a better sense of why I'm suggesting you should buy it. Thank you for your time.